Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Kevin Smith. Kevin Smith is an associate professor of accounting at the Stanford University. He completed his PhD in accounting at the University of Pennsylvania, Wharton School of Business. He has published into ranking journals in accounting, such as Journal of Accounting Research, Review of Accounting Studies, the Accounting Review, Journal of Accounting and Economics, and the Review of Financial Studies. Now we will start our seminar with dear Professor Kevin Smith.
Yeah, thanks a lot for the invitation to talk. And again, if you have any questions, feel free to jump in. So this paper is titled How Useful Are Earnings in Equity Valuation? Evidence from a Structural Model. And it starts out with what I think is a rather classic question in accounting research that is simply the question of how useful or relevant are earnings announcements to decision makers, specifically with respect to equity valuation. And again, this is a very old question that goes back to work like Ball and Brown and Beaver. And these papers pointed out that there's a challenge to just looking at the accounting statements. You can't just go look and say, does this information appear to be useful? The problem with that is that investors might have other sources of information. And so they might already know at the time earnings are released, the same information that they're getting through the accounting statements. And so the solution these papers posed was, of course, this event study approach where you're looking at market statistics in a window around the release of these announcements, with the idea being that the market should only respond to new information. So if we look at market reactions, we're just getting what is new to investors in these events. But I'm going to argue that there's still a problem with this, which is that even if the information in an earnings announcement is new to investors when it comes out, inevitably investors would have gotten the same information from other sources in the future. So for instance, this could be through other firms' earnings announcements. It could be through analyst forecasts. It could be through voluntary disclosures, or ultimately even the payment of the future dividends that investors receive. And the difficulty here is that just how long it would take the information and earnings to arrive via other sources is really critical to determining how useful they are. So just to give you two extreme examples, we could imagine that in one case, earnings information arrives just a day after the announcement, in which case it clearly wouldn't be very useful because unless you're making a decision on the date of the earnings announcement, you would have that information available either way, whether it came out via earnings or not. On the other hand, if earnings information wouldn't have come out for many years, then clearly, in that case, you're most likely not going to have that information at the time you're making a decision unless you observe the earnings announcement. So this is not an easy question to address. In some sense, I'm asking to figure out what decision usefulness is to investors. You have to think about a counterfactual of how much would investors know if they didn't observe earnings. And that's thinking about counterfactuals like this are a place that structural models can be useful, where we're actually modeling more formally the arrival of information in the market. So that's what I'm going to do. I'm going to try and address this challenge of figuring out when the information and earnings, when you would receive it if you didn't observe earnings by building a structural model. And the key ingredients of the model, first of all, the first one's going to be that the firm is going to be releasing a series of earnings reports that represent, say, quarterly earnings. The second feature is that these reports, and this is really the novel feature, they're going to bring forward information in time that would have arrived in the future from other sources. And I'm going to think very explicitly about when or from what time the earnings announcements are bringing information forward from. In other words, I'm going to very carefully model how long it would have taken that earnings information to be coming out via other sources. And the final feature is that the earnings reports will be processed gradually over time. There's a reason I'm allowing for this that I'll talk about momentarily. But the main thing is this is actually going to help me fit the data and also in the process provide some insights into how long it takes investors to actually process earnings. So when I say decision usefulness, this is a very a term that can be used in very different ways. So I want to be very careful just upfront about how I'm thinking about this construct of how useful earnings are. So what I'm thinking about is I'm thinking about a decision maker who's making a decision that depends on the value of the firm's stock. And they're making the decision on a typical day. So just kind of selected at random. They're going to be making a decision in one of two scenarios. In the first scenario, they observe everything, all sources of information, including earnings. And in the second case, they're observing everything except for the earnings. Okay, so the question is, what is the difference in the uncertainty over the firm's equity value across these two scenarios that they face? And as we'll see, it's kind of critical that I'm doing this on a randomly selected day. I'm just assuming they're just making a decision on a typical day. It's not that they wait until after the earnings announcement, let's say, to make a decision. And I'll come back to all of this. So what the model is going to show is that this notion of decision usefulness is going to depend on informativeness, which is just the overall amount of new information in the earnings. This is kind of what the existing literature is focused on. And then this notion of horizon, which is the term that I've used for this. And horizon just captures how long would it have taken the typical piece of information that's in an earnings announcement to arrive via other sources. And this is just coming from the intuition that I mentioned earlier, where if the information would have arrived very quickly, you're probably going to have it through another source when you're making a decision relative if it came later. I'll then show that informativeness and horizon actually affect volatility in a very particular way. Okay, so if you just look at the quarterly pattern in volatility, you broaden your focus from just looking around the announcement to looking over the entire typical quarter and look for patterns in volatility based on how many days you are into the quarter. That's going to tell you something about both of these two features. And because of that, you can just look at these quarterly patterns to back out what informativeness and horizon are. And so that's going to be kind of the main empirical exercise in the paper. And the final thing is, and this is somewhat of a different insight that comes along in the process of thinking about earnings horizon, is that you can more reliably estimate earnings processing time and informativeness. And in fact, the model is going to show that if you just ignore the availability of other information sources, as a lot of the existing work is done, you're actually going to get a biased estimate of processing time and informativeness. So you kind of have to think about all of this, even if you're focused on the simple problem of how much new information is contained in an earnings announcement. So again, I'm going to bring the model to the data and estimate it. And this is what the actual model fit's going to look like. I'm showing you this to show you just an overview of how I'm going to be estimating it. It's, again, based on return volatility over the quarter. And you can see that the model fits very well. So if you look at the blue line is just the model's fit to return volatility, and the black dots are the data. And so what does this tell us? Well, I'm going to show you that based on this pattern that we see here, the model is going to indicate that most of the new information in an earnings announcement would have arrived within roughly 2 months of the quarter. So it's somewhat short-dated information. I'll then show that if you think about these conventional metrics of informativeness, the classic one is the U statistic, which just compares the amount of volatility around the earnings announcement to the typical level of volatility during the quarter. That's actually going to understate the amount of new information in a typical earnings announcement by about 20%. But nevertheless, it's going to overstate earnings decision usefulness by roughly threefold. And the reason goes back to this first point, that the information in earnings tends to be kind of short-term in nature, would have arrived in some sense through other sources pretty quickly. And so you have access to it through other sources, even if you were ignorant to the earnings announcement. And finally, the amount of time that investors take to process an announcement actually exceeds the 3 to 5 day windows that we typically see being used in these event studies. It seems to take roughly 2 trading weeks before these earnings announcements are fully processed. And so these typical event studies might be missing a significant fraction of the actual information that's being conveyed by earnings announcements. So the paper is most closely related to all of this work over the years on looking at short window responses to earnings as a way to gauge their informativeness. So this is the value relevance literature. Because this is such a large and well-known literature, I'm not going to review it. Instead, I want to talk about some of the theoretical work that this is in some sense related to and just how it builds on that. So the first body of work is just the fact that, or this body of work that shows that accounting information or earnings announcements can either substitute or complement other information sources. In other words, you could think about if earnings contain more information, is there more information that's also coming out from, say, voluntary disclosures that firms provide or analyst forecasts? And the most natural relationship you might expect is that if there's more information in earnings, there's going to be less information coming out via other sources like, say, analyst forecasts, because the information, some of it's just that analysts would have provided, let's say, is already going to be coming out in the earnings announcement. Or vice versa, if there's more information coming out through historical analyst forecasts, then perhaps there's less information that will be provided to the market on earnings announcement dates. But the theory actually shows in some cases that the opposite relation holds, that there's complementary relationships between, let's say, mandatory and voluntary disclosure in certain cases. So the classic example of voluntary disclosure would be maybe voluntary disclosures become more credible when there's better or higher quality mandatory disclosures being provided to the market, because you can actually back them up and show that they're kind of founded in the actual fundamentals of the firm ex post, which would create more of an incentive to actually tell the truth with your voluntary disclosures. Okay, so in this paper, it's always going to be the case that earnings announcements and other information sources are substitutes. And there's a reason for that, which is that I'm considering all other information sources together. I'm not focusing on any individual source like voluntary disclosure. And the reason I'm doing that, I'm focusing on all other information sources, is because that's what's really going to be crucial for thinking about this notion of decision usefulness. You have to think about everything else that investors might know. And when you're thinking about all other information sources combined, it basically always has to be that earnings announcements are going to substitute for all other information sources. And this goes just to Bayes' rule. The idea is that there's kind of a fixed amount of information that can arrive in the market. And so if there's more information coming through one source, if you take the sum total of all other sources, the information has to decline. Okay, so the second body of work, and this is more recent work, primarily in finance, but this work is trying to think about what is the value of private information to investors who can take that information and actually trade on it. So what this work is trying to do is it's trying to think about, let's say, if an investor knows an earnings announcement 2 weeks ahead of time, and they could trade on that, just how much would they be willing to pay for that knowledge? And this gives you some sense of what is the value of that information source. However, in this concept, this notion of horizon that I'm talking about is not even a consideration, because it's just a completely different decision problem. I'm thinking about public information that investors can get and then apply in different ways after that public information has been made available to them. So the other thing we'll see is I don't have that specific decision problem in mind of an investor trading in the market. I'm going to be much less concrete about the decision problem I have in mind. So I'm going to be thinking in general about some arbitrary decision that's linked to the company's equity value. But I bring up this work because I think it's interesting, and there could be more work done on this area. I think it's kind of not been introduced or thought about in accounting to this point. And finally, the paper is related to a growing body of work in accounting that's applying structural methods. So I'll also be building on some of the methods from those papers. So the outline of the talk, that's kind of an overview. I'm going to start out by just telling you the model that I'm working with. Then I will go through the theoretical results that come out of the model. Then I'll talk about how I'm actually going to take the model and estimate it in the data. And then I'll show you what we learn when I do so. So the model is going to start out with a firm that's just traded over a sequence of dates, 1 through capital T. And on that terminal date, the firm is just going to pay a dividend. That's just a way to capture the value of the firm. So I'll call this dividend V. This is what the firm is basically worth to the investors who hold it. And we know in the real world that firms aren't just paying one single lump sum dividend at some date in the future. Instead, they're kind of paying, if at all, they might be paying some dividends in the short term, or eventually they will pay some dividends over in a sequence to investors. But during the period I'm focusing on, I'm going to assume away any dividends. And that is just a simplifying assumption that's going to make the math work a lot easier. But because we know that in any given quarter, dividends tend to be small relative to firm value, this shouldn't introduce any major biases when I take the model to the data. The second feature I'll assume here is I'm going to be looking at risk neutral investors. So they're just going to be pricing the firm based on their expectations of that terminal value. There's not going to be any discount rate or anything like that. And the reason that is that I want to think about firm specific information, which is typically what most of the information and earnings, I think, look like. So you could introduce risk aversion, and you could introduce, say, other sources of risk unrelated to earnings into the model without making a significant difference in the results. The one thing that I'm going to lose by making this assumption is I'm not going to be able to say anything about the information that firms' earnings contain on the macroeconomy or on market level aggregates. That would take a different analysis to do. So the firm's value is capital V is going to be something that you can break into a bunch of different bits of information. And those bits of information are going to be what's arriving in the market on a day-to-day basis. And the way I'll capture this is by just assuming that it's the product of a bunch of random variables that I call economic income. And these random variables are going to be log normally distributed. So these are going to be, you can write this as the exponential of the sum of a bunch of normally distributed variables, x sub t. And one of the key features of these x sub t's is I'm going to assume they have constant variance, which is just going to make it so that there's a steady flow of information into the market over time. It's not that some days there's just randomly more, or there's more information than others. I want to have the firm in a steady state as kind of the benchmark. And you might have seen models with kind of more additive structures for thinking about information rather than a multiplicative structure. The advantage of this multiplicative structure is that if there's good news that arrives in the firm versus bad news, it's not going to affect the information flows into the market, how much information is arriving into the market in the future. So this is going to keep the firm in a steady state, again, where there's just a constant information flow. So to get a bit more specific about this information flow, first I'll talk about non-earnings information. To capture this, I'm going to assume that on date T, one of these components, one of these economic income components is going to be revealed to the market. So I'll capture this by assuming that specifically x sub t minus delta is revealed to the market on date T. And so there's going to be a lag with which these economic incomes are made public to the market. And this is going to just let me have a parameter delta that captures how timely these non-earning sources of information are. But it's not really crucial to anything that I'm doing to have this lag. What is crucial is that one of these XTs is being made to the public to the market on each day as a means of capturing information arriving through sources other than earnings announcements. And as we'll see, this is just going to create a steady flow of volatility for this firm. So that's the baseline. With that, I'm going to introduce periodic earnings reports. And these earnings reports will just arrive once every kappa day. So kappa is capturing the number of days during a firm's quarter. And these earnings reports I'll call Y sub A. So these are just signals about the firm's economic income that are arriving via an earnings announcement. And I'll assume that Y sub A is a sufficient statistic for every announcement before it. So the 8th announcement contains all of the information in past announcements. This is just a simplifying assumption. You could always just assume that the most recent announcement is stacked onto it or all of the firm's past earnings announcements. This just keeps notation convenient. The other thing I'll assume is that the properties of these earnings reports are constant over time. So it's not the case that the firm's earnings are systematically becoming more or less informative, or that any other properties of the earnings announcements might be changing. Now, this is, if you think about this applied to firms at large or the average firm in the economy, we could have reasons that when I bring this to the data, this will be violated. We know, for instance, that there's been regulatory changes over the years that have caused firms' earnings announcements to become more or less informative, and it might be changing the properties of the firm's accounting systems in other ways. But what I'm going to argue is that if you're applying this model and estimating it on a sample where things are changing, where companies' earnings announcements are changing in their properties, it should approximate the average properties of the accounting system or the earnings reports over that period. So what I'll also do is I'll break down my sample when I'm estimating it into decades and see how things have changed over time according to the model. So how am I actually capturing the properties of these earnings announcements? Well, everything is going to be encompassed by a function gamma of tau. That's gamma as a function of t. And what this function represents is how much information are earnings bringing forward in time that would have otherwise arrived in the market t days into the quarter, tau days into the quarter. So this is very flexible. It's going to let me control just how much new information is there being provided to the market on the earnings date. That's just going to be the sum of the tau. So that will be all of the information. The sum of the taus, or the gamma of tau function, is going to reflect all of the information in the earnings announcement, regardless of when it would have come out. Okay, so why, if you think, why is that the case? Well, if gamma 1, for instance, reflects the information in earnings that would have come out 1 day into the quarter, gamma 2 is the information that would have come out 2 days into the quarter, and so on and so forth, and you just add that up, that's going to give you the sum total of all the information in earnings. But I have a lot of flexibility to actually control, say, whether most of the information in the earnings announcement would have come out in the very short term versus in the very long term by just changing around the level of the gamma function for different days into the quarter. So this is the function that I'm really interested in. It's going to let me actually say, as we'll see, just how useful these earnings announcements are. So it's going to play a key role. One other thing I want to mention about it is that it's going to be in percentage terms. So it's basically as a percent of the total information that would have arrived in the market t days into the future, what percent of that is being brought forward into the earnings announcement. So in the theoretical analysis, I'm going to leave this function essentially fully general, but when I bring things to the data, I'll actually impose a functional form on it that seems to very well fit the data. The only thing I will assume is that there is some date m such that gamma t is 0. So for any t greater than m, which is just to say that earnings announcements are not going to tell you about economic income that might be earned by the firm 1,000 years from now, let's say. There's just some point at which there's just no way for earnings announcements to predict that information. And that's just crucial to keep the model in steady state. Otherwise, as you start getting towards the terminal date, earnings announcements would mechanically become less informative. So the final component of the model is this fact that the earnings announcements will be gradually processed over time. I'm going to introduce this, even though it might seem somewhat unrelated to the central thesis of the paper, but I'm going to introduce it because it's actually essential for the model to fit the elevated level of volatility that we see after earnings announcements. And it's also, in the process, going to give insights into the rate at which earnings are processed when we bring the model to the data, and just how much new information there is in earnings. So how do I actually capture this? Well, I assume that each of these earnings signals y sub a can be broken down into subcomponents. So YA0, YA1, so on and so forth. And one of these components is revealed to the investors on each day following the announcement. So for instance, YA0 is the signal that investors process on the day of the announcement. YA1 is the signal they process a day after the announcement. and so on and so forth, all the way to D days after the announcement, capital D days. So there's some point at which I'm going to assume they will be done processing earnings, and the data specifically, I'll assume that is 3 weeks post-announcement. So then I'll have a function phi of t that just captures how much of the announcement has been processed T days into the quarter. It's also going to take as an input tau. So you could think of these earnings announcements as having, again, as having information that would have arrived on each future date into the quarter. And you might think of some of that information being processed more quickly than other components of the information. In theory, that could be the case. I'll assume that it's just an even spread, that investors kind of evenly process all of the information and earnings proportionally over time, regardless of when that information would have come out. So there's a lot going on in the model. I just want to recap this with a visualization that I think demonstrates what's going on. So what I'm showing you here is the processing of announcement A. Again, there's kappa days in the quarter. In this simple example, I just made it so there's 6 days in a quarter. And I'm assuming here that it takes, say, 3 days for investors to process each announcement. Okay, and so we have economic income associated with each future date. And the first feature of the model was that investors are observing a component of economic income on each date that just reflects the continuous flow of information into the market. So that's why we see these blue boxes kind of moving further and further forward to the right. That just reflects investors over time processing the most recent day of economic income. Okay, what happens on the earnings date? Well, investors also get these forward-looking signals about economic income in the future. And that's what's captured by these red boxes. These are the information in the earnings announcement on future economic income. And at some point, again, there's just no information in earnings on economic income that looks very far into the future. And that's why the boxes turn gray. Now, during the processing period, investors are actually processing more of the information, and that's why I have this red shade ticking up. That just reflects investors' even processing of all the information in earnings over time. And then you see that in the next announcement, so this is the A+1th announcement, everything just repeats itself. Okay, so that's an overview of what's going on in the model. Now I want to talk about what we actually get out of this model, and there's 2 main things that I'll touch on. The first one is it's actually going to let me characterize how useful are these earnings announcements. And again, it's going to come down to that gamma function. And then it will let me, what I'll do is I'll actually derive return volatility over the quarter in the context of the model. And I'm going to do that because that's going to be essential to how I actually estimate the model and the data. Okay, so again, the first thing I'm going to talk about from the model is just this notion of how useful these earnings reports are. And as I mentioned at the beginning of the talk, the notion of decision usefulness I have in mind is one where we have a decision maker who's making a decision on a typical day. And I want to ask, what is their perceived variance of the firm's equity value if they do observe earnings together with all other information sources, versus if they don't observe earnings, they just observe everything else. And so decision usefulness is naturally a difficult thing to think about and estimate. This is a specific concept of decision usefulness. And so I want to caveat the limitations of this notion. First of all, I'm not thinking about a world where there's no earnings announcements and comparing that to one where there are earnings announcements. That would be interesting if it was possible, but it's very difficult to actually talk about the world without earnings announcements because we know that announcements affect the information that's coming to the market via other sources. Okay, so it could be the case that analysts are only able to produce information because they have the backbone of being able to see companies' accounting reports, or at least that those accounting reports assist them in producing the information they do. It's just one example. So if we wanted to get to the counterfactual without earnings reports, we have to think about how they're affecting the incentives of every other agent in the economy to produce information. Okay, so again, I'm just thinking about in the current reporting environment, how much additional uncertainty would you face if you were ignorant to the earnings information? And I think that's still a useful concept because it tells us in the current reporting environment just how much of a role our earnings playing in driving investors' beliefs. The other feature of this is that I'm going to be including in this notion of the earnings announcement every piece of information that arrives in the market on earnings dates. So it's going to include not just the earnings number, but also the financial statements, any guidance that managers are providing, any analyst forecasts that occur in a very short window around the announcement. So this is kind of a similar limitation that we have in every short window event study of earnings informativeness. We're looking at price reactions around the earnings announcement that naturally is going to encompass everything that comes out on those dates, not just the earnings report. The next thing is that I'm not going to be able to, this definition doesn't speak to earnings usefulness in settings where it just doesn't matter if earnings information is new or not to investors. It's just the case that earnings are useful because they're verifiable. They're a hard, concrete piece of evidence that you can use in contracting. And we've seen this limitation of all of these market-based metrics of usefulness in other settings, but I just wanted to reiterate that this is specifically about valuation. I can't speak to the usefulness of earnings in contracting settings. And finally, we know that different decision problems don't always reduce to the variance. So the variance isn't always the right notion of how much or how well off you are if you're making a decision problem that depends on firm value. We actually know that there's no single statistic that's going to work across every decision problem you can think about. This just goes back to Blackwell and Dembski's work on reporting regimes. So the goal isn't to obtain a super precise general metric of decision usefulness that applies to all settings. Again, it actually doesn't, such a thing doesn't exist. Instead, it's just to get a simple statistic that you can calculate, say, compare across time, across firms, and that relative to the existing methods is also going to account for the availability of other information sources. So formally in the model, what is this notion of decision usefulness? Well, again, this is a decision maker who's making a decision on a random day. And so I'm going to be averaging their uncertainty over each of the potential days that they might be making a decision. And then I'm going to be looking at the variance of basically the log firm value minus the log of the prior mean of firm value. And so this is just a metric of returns, the firm's ultimate returns. And so I'm putting this all in terms of returns and not the level of firm value because this will lead to a metric that's independent of the scale of the firm. I don't want a metric that's just mechanically going to be higher for large firms because they're larger. And so naturally they're kind of more important. Instead, I want something that's comparable across firms regardless of their size. And I'll be comparing the variance without the reports to the variance with the reports. Specifically, I'm basically starting out with this NR, that's just all of the information that investors have without earnings. And then with the reports, they observe that plus the earnings announcement. So I only have to include the most recent earnings announcement because it's a sufficient statistic for all prior announcements. So I go through the math and actually derive what this decision usefulness is. And it comes down to the product of two terms that I call I and H. These are the informativeness and horizon of earnings. And so the informativeness statistic is very simple. It's just the sum of the gamma function times investors' prior uncertainty. And so this goes back to what I was saying earlier. Gamma is just how much information earnings are bringing forward from any specific date. And so if you sum this up over all future dates, you're just getting the total amount of new information that's coming to the market via an earnings announcement. So this one's intuitive. If you look at horizon, it's a little bit more difficult to figure out what's going on with that. So It turns out that this horizon statistic is something that varies between two values. The lowest possible value it can take is 1 over the number of days in the quarter, kappa, and the highest value it can take is just 1. And so these two extremes help to elucidate what exactly earnings horizon is capturing. So when it's its maximum value, again, that's when earnings are most useful, because we can see that, again, it's the usefulness of earnings is going to be increasing in H, or the horizon. So when is that the case? When is horizon such that earnings usefulness is maximized? Well, this is going to be the case where the information in earnings would not have arrived for at least 1 quarter. So why is that the most useful possible case for earnings? Well, that means that the most recent earnings announcement on a typical day, if you just take the most recent earnings announcement and you didn't observe it, there would be no substitutes for that. There's no other sources you can look to obtain the same information if it wouldn't have arrived until the next quarter. So in this case, it's never the case that you can substitute away for earnings information by looking at other sources. On the other extreme, when H is 1 over kappa, this shows up when all of the information in earnings would have come out the day after its release. Okay, so in that case, unless you're making a decision on the day of the earnings announcement, you get nothing by being able to observe earnings. Okay, so that's kind of, you think about these two extremes, one where it's all coming out the next day, one where it wouldn't have arrived until the next after, into the next quarter or later. And you start thinking about moving between these extremes and just having earnings information come out later and later, then that's kind of what H is capturing. It's how far you are along that continuum. One other thing that's kind of interesting to think about out of this is that decision usefulness is the product of informativeness and horizon, and this is intuitive. What this is saying is that the only way that earnings are useful is that both of these are high simultaneously. So you can imagine an earnings report that's incredibly informative, contains a ton of new information, but that information would have arrived pretty soon after the earnings announcements. Well, that's not going to be all that useful, because you would probably have that same information through other sources when you make a decision. And likewise, you could think about an earnings announcement that has a very long horizon, so the information wouldn't have come out for a very long time, but there's just not that much new information there. Well, that's also not very useful. So you have to have a lot of information in earnings, and it has to have a significant horizon for it to be useful. This horizon statistic, a couple other things that help reveal what it's capturing. Number one, if you just scale it by a proportional value, so you're just kind of increasing the amount of information in earnings and you're keeping it proportional so that you're not kind of moving around the fraction of that information that would have arrived one day versus another, then that's going to have no effect on H. On the other hand, if you increase gamma T, so you increase the amount of information in earnings that would have arrived T days into the quarter, and you decrease the amount of information that would have arrived T minus K days into the quarter, you're going to increase H, because you're pushing out when the information would have arrived in earnings without changing the total amount of information. Okay, so the one important feature of this is if you do that, if you were to kind of push out earnings information, it would increase the usefulness of earnings because you're increasing H, and yet you'd have no impact on the relationship between earnings and returns upon their release. So if you were to look at things like ERCs, the response coefficient on earnings, or the amount of volatility that earnings are creating upon their release, they're completely independent of this horizon statistic, and so they don't capture this component of earnings usefulness. So that's it for talking about decision usefulness in the model. The next thing I want to talk about is return volatility. Again, this is how I'm going to actually estimate the model and the data. And I'm going to start out with just as a benchmark to show you what would happen if there were no earnings reports. Well, if you look at return volatility over time, it would just be constant. And that's kind of by assumption. I've set up a world where there's steady state information flows into the market. But then we introduce these earnings reports, and they create very systematic patterns in volatility from quarter to quarter. The first thing we get here, and kind of we're pretty well aware of this from the literature, is that on earnings announcement dates, volatility is going to spike up because there's information arriving in the market. But the other thing that's going to happen is that during the rest of the quarter, volatility is actually going to go down. Okay, and that's relative to this baseline level you would have without earnings announcements that I have in this dashed line here. Why is volatility down? Because now if there's more information coming out in earnings dates, there's less information to come out on other dates. And so if there's less information coming out at other points, prices move less at that point. But just how strong is this effect? How much is volatility going to be reduced on these other dates? That's going to depend on how much earnings are bringing forward information from those dates. So it's going to depend on that gamma function. If earnings are bringing forward a lot of information that would have arrived in the short term into the quarter, you'll see volatility being much lower in the short term. If they brought forward a lot of information later in the quarter, then it would be lower later into the quarter. So the formal result here is if you look at volatility T days into the quarter in a period where the announcement's been fully processed, it's going to be scaled down in proportion to gamma T, in proportion to the fraction of the information that's been brought forward into the announcement. I'll also derive volatility in the period in which earnings are being processed. So remember, I allow this to take some time. The only thing I want to point out about this is it's a pretty complicated function. There's a lot going on in this period. So some of the things that are making this complicated is that previous announcements information is still relevant when you haven't yet fully processed the current announcement. Okay, so the current announcement is a sufficient statistic for previous announcements, but you don't know the entirety of that earnings announcement yet. Then there's going to be the arrival of information via the current earnings announcement and the arrival of information from other sources. So I'm going to deal with all of this when I'm estimating the model. It turns out that this isn't actually all that tricky to handle. So how do I estimate the model? Well, the basic idea for the main kind of central part of the identification, or how I'm estimating it, I think is probably already pretty straightforward. As I mentioned, when gamma T is high, that means earnings are pulling forward more information that would have arrived T days after the report. And so if we see a low level of volatility during a specific period relative to the typical level of volatility, that indicates a higher gamma T, and I'll be able to actually derive gamma T in the data. Now that's the basic idea. It turns out it's a lot more complicated than that, because we need other estimates to do this. We need an estimate of sigma x squared in the model, which is just that overall level of uncertainty. We also need to figure out, what about once we're looking at gamma T into the next quarter? So this is only going to work when you're looking at a T days into the quarter where T is not more than the number of days in the quarter. So that's something that's going to need to be handled. And then this also isn't going to work during the processing period when earnings are still being processed. There's other drivers of volatility other than just the arrival of non-earnings information. As I just showed you, there's this complicated function that drives volatility. And so there's going to have to be some way of dealing with that. So I'll try and give you the basic idea of how I address those additional challenges. Again, the first one is just we need some measure of prior uncertainty, sigma x squared. This is driving the overall level of volatility over the quarter. So this whole line of reasoning is about relative volatility. How much volatility is there in a particular period relative to the typical level of volatility as driven by sigma x squared. So it turns out that, in fact, you can estimate sigma x squared just by looking at the average return variance over the quarter. That will always be identically equal to sigma x squared. And what's the intuition for that? Why would investors' uncertainty drive the average level of volatility in the quarter? Well, you could think about these complex patterns in volatility during the quarter being driven by earnings announcements moving around when information is being learned by market participants. So earnings announcements will move, again, it's moving around the resolution of information, but it will never affect the total amount of information that's arriving in the market. That's just fixed by investors' priors. So this is because the model is just taking the firm's cash flows as given. There's a fixed amount of uncertainty to be resolved. And so you can't change that by just releasing the earnings announcements, and how they move information around over time won't change that fact. So that's easy. It's pretty straightforward to estimate sigma x squared. The remaining steps are a bit trickier. So to guide you through the intuition, I have this visualization. This is just what the actual data looks like. This is what return volatility looks like over the quarter. So we see it's high, then it kind of comes down and it slopes back up until it hits this dashed line, which is the average level of vol over the quarter, and then it kind of flattens out. So first I want to actually estimate this gamma function. And as I mentioned, I'm just going to do that based on the level of vol during this period after which the announcement's been fully processed. And I'm actually going to fit a linear function to this because, as you can see in the data, it's very close to being linear. It's actually piecewise linear because at some point we see that vol it flattens out. Okay, so that will let me have an estimate of the gamma function during this period. The one thing is, again, we need to estimate gamma t into the future, into the next quarter, and that's not something we can directly do. But what we do see is that gamma is kind of flattened out at this point. And what this means in the model is that earnings announcements actually aren't bringing forward any information from this period onwards. And so I'm just going to extrapolate that into the future and say that indicates there's not any more information arriving in that would have taken or would not have come out for the long term. Of course, that's an assumption. It is a limitation, is that there's just no way to figure out gamma t for more than one quarter into the future unless you're willing to extrapolate based on what we know at the end of the quarter. I'm also going to extrapolate what I've estimated for gamma backwards in time. And that's because to figure out how much volatility is driven by announcement processing versus non-earnings sources of information arriving in the market, I need some kind of estimator of that non-earnings information arrival. And that's what I can get by just extrapolating what I've estimated based on this linear trend backwards into the announcement processing period. Okay, so again, this extrapolation is going to give me an estimate of, during the processing period, how much of the volatility is driven by the arrival of non-earnings information. I can then compare that to the actual level of volatility, and that's going to tell me how much volatility is driven by the processing of earnings news. Now, if we think of this as just the amount of volatility driven by earnings, and we compare this to existing methods, what do existing methods do to figure out how much volatility is driven by earnings? Well, during this period around earnings, they'll just compare the actual level of volatility to the average level of volatility over the quarter. But the model actually suggests that's not the right thing to do. Why? Because volatility, it argues, will actually be much lower than the average level during the quarter if you were to just think about earnings having been fully processed immediately. So this is basically too high of a benchmark level to compare earnings volatility to. So the existing methods, they would be taking kind of this green box as the earnings-driven volatility. And my estimation suggests you should take this whole area. And so this red area is being ignored by those studies. And that's going to be why I'll actually estimate that earnings are more informative than would be suggested by the existing methods. And they also take longer to process. So you can see this, you're following the existing method, you think that earnings are done being processed around here, whereas in reality, it takes until significantly later. So that's the basic idea of how I'm doing this. Some more of the specifics. Again, I'm thinking about firm-specific information, so I need to get at that by looking at idiosyncratic returns, firm-specific returns. And I'll estimate that using a factor model. I do this in various ways that I talk about in the paper. So I'll do this using historically estimated betas. And then in an appendix, I also look at industry-adjusted returns, raw returns, residuals from contemporaneous Fama French factor regressions. Why am I doing this in a bunch of ways, or why am I concerned about robustness? Well, as far as I can find, there's no other work in the literature that has shown this pattern in volatility over the quarter. The fact that it spikes up is known, but the fact that it then kind of bottoms out and slowly moves up during the quarter, I haven't seen anywhere else. And so I just want to demonstrate that that's actually very robust, that everything I'm doing here is not driven by the precise approach that I'm taking to estimate idiosyncratic returns. Again, it will even hold if you were to just use the level of returns and not make any adjustments. Okay, so again, what I'm going to next do is fit the gamma function during the period after which earnings are fully processed. As I mentioned, I'll fit a piecewise linear function to that because that's kind of what we see in the data. And so it has to be piecewise linear because it kind of has to flatten out once you're at the average level of vol according to the model. Because if the model suggests that if gamma t is 0, so earnings are not bringing forward any information from that would have otherwise come out t days into the quarter, then the volatility at that period is just equal to the average level of vol over the quarter. So you can't go below 0 for this gamma function. It's a theoretical lower bounds. And so in order to maintain that, I have to, in fact, have a model that fits that drop off towards the end of the quarter that we see in the data. And I'll fit this via least squares on realized volatility on each day. So after doing that, I need to actually figure out the rate of information processing and as captured by that phi function that I had introduced earlier. And I won't go through the details here, but basically given an estimated gamma, given the observed variances we see, and given our estimate for sigma x squared, we can recursively move backwards in time and figure out this gamma function. As we'll see, this will actually perfectly fit the data, this procedure. And to get standard errors, it's not trivial. If you wanted to analytically derive them, it would be quite difficult. And so I'm going to bootstrap, applying block bootstrap and sampling at the announcement level. All right, so what do I find? Well, again, as I showed you earlier, this is the model fit. It fits very well. We see this piecewise linear gets very close to the actual data. And then when we go back in time, we get this perfect fit to volatility during the processing period. It's not surprising in some sense the model is fitting so well is because I have a lot of parameters in the model to tune to fit the data. So what do we actually learn from this model fit? Well, the first crucial component is what do we learn from the fact that we do get this uptrend in volatility over the quarter? If we go back to the intuition for how the model is being estimated, remember that when gamma t is higher, volatility is lower. In other words, during periods when earnings announcements are bringing forward more information in time, volatility is lower. So the fact that this is an uptrend indicates that earnings are bringing forward more information that would have arrived earlier in the quarter than later in the quarter. It actually suggests that most of the information in earnings would have arrived pretty early into the quarter. The fact that volatility's reached its average level by about 50 days into the quarter, again, that means that gamma t is estimated to be 0 about 50 days into the quarter. In other words, earnings are no longer bringing forward information that would have arrived that far into the future. Again, suggesting that the horizon of earnings information is somewhat low. We need to caveat this, though, because this is on average across all firms. It's certainly the case for certain firms that they will be bringing forward information that's longer in nature. Fortunately, I can't actually estimate the model on, say, a firm level basis because it requires a pretty large sample to actually to estimate. If there's too much noise in this volatility pattern, the estimation procedure breaks down. And as I'll mention at the end, I think that might be an avenue for future research to think about. All right, so what are the actual parameter estimates? The first one is, you'll see all of them here. The first one I want to emphasize is just that H parameter, that horizon parameter that multiplies the informativeness to give you decision usefulness. And that's about 1/3. So what is that saying? That's saying that if you were to just look at the amount of new information in the earnings, that actually considerably overestimates how useful earnings are because of the fact that this pattern suggests to us that investors have considerable other sources of information that would substitute for earnings if they couldn't observe them. The second thing I want to emphasize is that if you just look at the sum of the gamma t, which captures the amount of new information, it's actually 20% higher than that U statistic. Remember, the U statistic is what existing literature has used to capture the notion of informativeness in this sort of context. So this tells us that earnings are actually considerably more useful than existing methods would suggest. And this goes back to that illustration I had showed, where these existing event study-based approaches are missing or applying the wrong benchmark for gauging the amount of volatility driven by earnings announcements. And finally, this fee function is again telling you how much information in the earnings announcement has been processed by a given date. So phi of 3 is how much of the earnings information has been processed 3 days after the release. And it's only 77%. So event studies will typically stop their cutoffs 3 days after the earnings period begins. And this is suggesting that that's missing about 23% of the information in earnings announcements. It goes back to that same plot where the benchmark that these studies are applying for when earnings processing is done is a bit too early. Okay, so the next thing I do is I apply this across different segments of firms. I'll look at large versus small firms. I'll look at growth firms or high market to book versus low market to book. And I'll show that, first of all, earnings horizon seems to be greater for growth firms than value firms. I've struggled to exactly explain why that might be the case. But it could be linked to the external sources of information, non-earnings sources of information, being more timely for value firms, to the extent that they're driven by kind of known performance metrics and industry demand type metrics. I'll show that earnings usefulness is actually higher for small than large firms. And that's, again, consistent with the same line of reasoning. There's just less external sources of information. But the U statistic actually gets that wrong. So it would suggest that large firms have more useful earnings. So this goes to show that if you don't apply this sort of methodology where we're thinking about horizon, you would come to the wrong conclusion and think that large firms' earnings are more useful. Finally, I'll look at this over time. I'll show that earnings informativeness, consistent with a lot of literature, has gone up over time. And so this is just kind of validating what existing work has found or replicating it. But at the same time, horizon has tended to increase, especially in the most recent decade as well. So if you look at the usefulness of earnings, it's kind of skyrocketed in the most recent decade. And I think the reason for that is in part just due to the increase in managers providing guidance that's bundled with their earnings announcements. If we look at firms that guide that versus don't guide on their earnings announcements, we actually would see that horizon is much larger for those that guide. And I think that's intuitive. If we think about managerial guidance, it tends to be further forward-looking relative to earnings information or the information in the accounting reports. And so that's kind of what you expect, is that it probably would have taken guidance information more time to arrive via other sources. Okay, so just to conclude, the overall takeaways from the paper, the first one is that earnings usefulness cannot be assessed if you don't think about when earnings information would have come out through other sources. I think it's a very simple point, but nevertheless, I haven't seen it in any existing work, perhaps because, while the point makes sense, it's not easy to address using reduced form empirical methodologies. And because this feature is not something you can get by just looking at short-term price reactions to earnings, it's kind of been left out of our existing measures. I'll show that if you expand your what you're looking at empirically from just looking around the announcement to looking over the whole quarter, it seems possible to actually back out what horizon is, or at least estimate it. And when you do so, it suggests that earnings contain more information than existing studies would suggest. But this information is less useful than if you were to just look at price reactions. So the directions for future work that I see are, it would be nice if we had some way of getting at horizon that didn't take this full structural methodology, and that could be imported into other studies that just will use panel regressions. I've had some thoughts on how to do this, but I haven't yet implemented it or or tried to based on option prices. And finally, we could think about more structured decision problems, not just thinking about the variance, but maybe some of the specific decisions that agents take based on accounting information and trying to quantify the decision usefulness of earnings in those contexts. So that's all I have. And thanks again for the invitation. And feel free to reach out if you have any questions.
Yeah, thank you very much, dear Professor Kevin, for your contribution and your effort. It's really an excellent presentation, excellent paper. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question. Yes, Vicky, you have a question? Vicky, you have any question? If anyone have any questions, please open your mic and ask your question. And David, you have any question?
So first of all, thank you for the excellent presentation. And it seems like the empirical work and all the theoretical work is well executed. Then in the presentation, you said that this touches upon a classic question that has been studied since Ball & Brown, 1968, and Beaver. So it seems like the research that you're doing now, it's providing like much more incremental contribution to what they had done back then. Then taking into consideration the prior literature and what you have done today, and then the suggested future research about horizons, what kind of steps would you suggest to like a PhD candidate regarding like going into this research? Should I just start off by searching for more settings in which earnings can be like simulated, or how do you think we can delve into the future research that you had suggested? Like, what are some next steps that you would immediately suggest?
Yeah, I mean, I don't have anything super concrete outside of the future directions that I suggested at the end. I think idea generation as a PhD student in general is quite hard to predict. So I feel that, you know, how I did it was I kind of found a question early on that was clearly very interesting, but just difficult. So I think that's kind of approach I've taken with this probably as well, as I had some idea that all right, it would be great if I could figure out how to do this. And then keeping that question in mind, as I read a bunch of different papers, I would always kind of return to thinking, like, based on this paper and this methodology, is there some way I could apply that to this question I had? And so eventually just relating everything back to this kind of thing I was interested in, that's how I came up with the solution. So yeah, I think that's my approach, but there's a lot of different approaches that you can take to kind of, yeah, I think everyone kind of has a different means for how they're kind of generating ideas in that sense.
Thank you.
Yep.
Are there another question? If anyone have any questions, you can open your mic and ask your question. Hong, yeah, you have any question? Hong? Hango? You have any question? If anyone have any questions, you can open your mic and ask your question.
All right.
Hello, my name is Ken. I'm a research professional at the University of Chicago. I am still young, and I like the empirical nature of the work. And I'm asking myself that I like this kind of works, but I don't know how best I could be able to understand the things easily, and also to be able to do something like this. What do you suggest I could do? Thank you.
Yeah, I mean, I definitely think reading finance, because there's not that much structural work in accounting. I think if you just jump into any of the structural papers out there, it's probably going to be quite difficult. So yeah, I feel that you need to kind of, it might be better to start out with some of the resources in finance and economics that kind of break things down to a greater extent. For this paper, I think a lot of it came from learning about asset pricing sort of stuff, and just yeah, it probably came from a lot of the foundations from my PhD classes in asset pricing. So I think those in general are quite useful. And then for structural methods, another good place to look actually is there's a review paper recently by Jeremy Bertomeu and some co-authors, my colleague Ivan Mrnovich. So that definitely will help show a lot of the methods. I think one of the nice things that paper emphasizes is that, for me, a big burden to doing structural methods for a while was figuring out how to do the standard errors, because it's a huge headache, very specific to different settings. And that paper argues that you can do bootstrapping in a lot of settings. And it also gives a very good intuition for the basic idea of some of these estimation procedures that look pretty daunting at first, like generalized method of moments. If you haven't seen it applied, just from a theoretical level, it seems pretty abstract, but it gives a good intuition for exactly how it's working. And then once you have that, I think you can start to think about different ways in which you can take features of the data and use that sort of procedure to back out what you're interested in.
Thank you very much.
Yeah.
Any other question? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Kevin, for your contribution and your effort. It's really an excellent presentation and an excellent paper. Thank you very much, everyone joined us today, and thank you very much to take a time out to present it to us today, dear Professor Kevin. It's been really appreciated.
Thanks. Yeah, thanks again for the invitation, and thanks for everyone for coming out today.
Yeah, and I hope to see you soon in Egypt. You are very, very welcome.
All right, awesome. See you later.
Yeah.